If your goal is financial independence, then you may be asking yourself, is it better to pay off your mortgage early or use that money to invest? In this video, I'm going to compare the two options and share some of the pros and cons. Understanding what's best for you is going to depend on a number of factors, including what interest rate you pay and the length term and how your mortgage is broken down. From this, you can work out what makes most financial sense for you. If you're new to this channel, I'm Matt, I'm a finance consultant. I've spent over 8 years working for one of the top consulting companies in London. I now run my own company, and on this channel I talk all things personal finance. So let's first look at mortgages. A mortgage is a bank loan to a property buyer, and it's typically made up by the loan amount plus an interest charge from the bank as a percentage of that loan amount. Mortgages follow something called an amortization schedule, which shows each payment due on the loan until the end of the mortgage term. If we go through an example, John is 40 years old and has a mortgage of £200,000 on a property worth £400,000, so a 50% loan to value. The mortgage term remaining is 20 years and the interest rate on the mortgage is 5%, so the monthly repayment is £1,320. At the start of the mortgage repayment, £487 per month goes to paying down the loan and £833 goes to interest on the loan. That means that the total cost over the full term of 20 years, if the interest rate remained the same at 5%, would be £316,779. Meaning over £116,000 is paid in interest on top of the original £200,000 mortgage loan. So when looking at the financial benefit of paying off your mortgage earlier, if you can reduce the loan amount faster, then not only are you paying off your mortgage quicker, you're also reducing the amount of interest paid on the mortgage, saving you a lot of money over the long term. Paying your mortgage off early has a number of benefits. Firstly, it gives you increased peace of mind and reduces your risk, as the smaller your mortgage is, the less chance you'll have of financial problems, for example, covering a period of unemployment or long-term illness. Secondly, it lowers your debt-to-income ratio, which may enable you to secure additional loans to fund other investments or business ventures. It can also have tax benefits. If you're investing in stocks and shares, then any income or capital gains outside an ISA is taxed. In contrast, paying down your mortgage delivers a tax-free return via the future interest payments that you'll never need to pay. And the final point is that it's simple. You just make the early mortgage payment online or over the phone with your bank, compared with investing in stocks or shares where you really need to research before investing. Now let's look at the opportunity cost of using that money to invest instead of paying back a mortgage faster. If you were to invest in the stock market, for example, the average annualized returns on the S&P 500 is around 7 or 8%. There is risk in the stock markets and returns can fluctuate each year. For example, with the financial crisis in 2008, markets dropped and returns were on average negative 37%. So a lot of people who had investments in the stock market and sold at this time were losing money. In this year, it would have been better to pay back your mortgage than invest. But then the stock market rebounded in 2009 with returns of 26.5%. So in that year, it would have been better to invest rather than pay back your mortgage. It's hard to forecast the ups and downs in the stock market, and generally investing with a long-term mindset reaps the best rewards. The opportunity cost of investing versus paying back your mortgage early really depends on your personal situation and the economic climate. You'll need to consider things like how many years do you have left on your mortgage versus how many years left to invest, what's your loan to value, and what are the current interest rates. But generally speaking, the more time you have left on your mortgage, the greater the potential benefit of investing is over that same time period. That's because of the power of compounding your investments. Let's look at some examples. Based on the example I gave earlier of a property owner with a £200,000 mortgage over a 20-year period at a 5% interest, I've looked at the following 4 scenarios. Scenario 1 is a standard repayment mortgage with any spare cash being spent on lifestyle. Scenario 2 is a standard repayment mortgage with spare cash of £500 per month going on mortgage overpayments. Scenario 3 is again a standard repayment mortgage but with the £500 per month spare cash being used to invest rather than make mortgage overpayments. And then scenario 4 is an interest-only mortgage, making 0 payments on the loan amount, only paying mortgage interest and then investing 100% of the remaining money. Calculating net worth for these 4 scenarios shows that investment scenarios 3 and 4 give the best financial outcome. with the interest-only mortgage and investing the remaining money the overall winner. This is because the returns from investing in this example are higher than the interest rate, and you compound the returns immediately, which grows the net worth balance exponentially. When the variables and assumptions change, so does the outcome. If the investment return is only 3% and the interest rate remained at 5%, then scenario 2, where you're paying back the mortgage, is better. And if you adjust the mortgage length and you only have 5 years left on the mortgage, then the financial benefit is much closer between paying back the mortgage and investing, as the benefits of compounding investments over time is greatly reduced. The two key takeaways are: the lower the interest rate, the better it is to invest. And the longer the mortgage time horizon, also the better it is to invest. Although more risky than paying back your mortgage early, investing can give a larger financial benefit. It really depends on your personal circumstances. I suggest using a mortgage versus investment calculator like the one I've shown in the video today, and put in your own personal situation, and also speak to an accountant and mortgage advisor to work out what's best for you. I hope this video has been helpful. Feel free to leave any questions in the comments and give the video a like and a subscribe, and I'll see you next time.